Dividend stocks versus growth stocks. Which strategy actually makes you more money? Hi, I'm Ace, and I built a 400k portfolio in just under 5 years in my early 20s by using Warren Buffett's value principles, my bachelor degree specializing in finance and investment, and the real estate cycle. And today, I'll share with you which strategy actually makes you more money. Let's start with dividend stocks. Now, people love them because they pay you a regular income, say 3 to 4% a year, which sounds great. But here's what actually is happening. The second the dividend is paid out, the stock price drops by roughly the same amount. You're not richer, you've only just pulled the value out of the company into your wallet. And worse, dividends are taxed straight away as income, and you can't make the most use of the capital gain tax discounts of up to 50% if you're in Australia. Now compare that to holding quality growth value stocks. These are businesses with wide moats, strong balance sheets, high margins, and high returns on equity. And instead of paying out their profits, they reinvest into expanding the business, buying back shares, or compounding capital at very high returns and rates. And that's exactly what Warren Buffett actually looks for. Wonderful businesses at fair prices that can grow for decades. Now, one thing to note, all dividend growth and value stocks fall hard in downturns as well. But here's where the real estate cycle comes in. We're now near the end, which means volatility ahead. Dividends will not protect you in a crash. But after the reset, those quality value growth names bounce back the hardest. That's where you can make multiples, not just, coffee monies. Well, there you have it. I do break down how I use Warren Buffett's value checklist and the real estate cycle to spot these opportunities in my free newsletter, link in bio. Which one do you prefer? Dividend payouts now or compounding wealth through quality growth value stocks? Comment down below, I'll be checking.